Hey guys, welcome to another episode of House Ready. My name's Cacy Matano with Austin Credit Care.
I'm Tasha Green with Go Green Realty Group.
And today, guys, we are talking to you about what not to do when you apply for a mortgage. If owning a home is a goal of yours to buy your first home in the next year, or you want to buy a home in the next year, these are things you should not do if you're going to want to complete that. So let's just dive right into it. What's something that you should not do if you want to apply for a mortgage?
One of the biggest things you definitely don't want to do is quit your job or have large gaps of employment in your employment history. A lender goes back 2 years. They want to make sure that you have sufficient income to make sure that you can responsibly, make on-time payments on your mortgage.
Okay, so don't move jobs. Definitely don't walk out or anything like
Right.
that. Try not to get fired. But what about promotions? Or what about if you did find another job and it's like a way better income and you don't want to miss the opportunity, but you still want your house? Or what happens with those cases?
Okay. Those are explainable circumstances. So what you want to do, I recommend, is put in your notice like you should.
Okay.
Keep that written notice, and then keep your offer letter. If you can explain, if you have a situation where you have that documentation, the timelines match up, that shouldn't be no problem. That should be justifiable to a lender. Even in a situation where you have to move out of state, let's say you have an ill parent or an ill family member and you need to move to a different state. But you put in your notice, you got the new job and all the time frames line up, that shouldn't be a situation that should hold you back from getting a loan. Even if pregnancy, a lot of times, what do we do in the event that we're having a baby, now we're running out of space, we need a bigger house. That's explainable. You go on FMLA, you're 6 weeks, you go back to work. That can all be justified with the lender. Just keep your documentation.
Okay, so if you're going to move jobs, make sure it is if it is for a better position or a higher income, it's okay as long as you have the documentation to track that. And then you want to make sure that it is like an income increase and stuff like that, right? Like you wouldn't want to make the move if it was something that lowered your income or something.
Absolutely.
Like that.
And it can even be a situation of a lateral move as well.
Okay.
Yeah.
You want to be able to line up, and definitely no gaps in income.
No large gaps. Unless it's something you can have documentation and very much explain. But when they see that gap of employment, they're definitely going to question it, and you need to have a really good supporting circumstance to be able to get that approved through the underwriter.
Okay. So you don't want to move jobs unless it is something probably that's going to bring, a substantial change, good change. So try not to move jobs. What else? What should you not be doing if you want to apply for a mortgage?
One of the things you definitely don't want to do is you don't want to obtain new debt. So you don't want to, get into more financial debt because it could be a situation where it can affect your DTI, which is the debt to income ratio. And that can affect your situation of your buying power. So the more debt that you obtain, it can affect how much house that you're able to apply for. And in this situation also, it can affect your eligibility out of certain programs like down payment assistance or being eligible for USDA loan.
Okay. Now, I know a lot of, when you say you can't have added debt is its own category. Debt is different from a credit line. So when you say debt, that means you cannot be taking out a loan. You cannot be financing something that, that's a big ticket item and have to make payments on it. But you can open credit lines. If you do need emergency funds or you need to have those funds, you can take out, a credit line, and the only debt you have on the credit line is the debt that you put on it, which is your balance. And you can control that and you can pay it, what that is, versus signing up for a loan. You're immediately signing up for X amount of debt for the entire loan. Versus with a credit line, you can have 20 grand on your credit line, but only be using a little bit of it, or what you need.
Absolutely. One of the questions that I get a lot too, and it's funny, but it does really happen, is furniture. just wait till you get the house until you get the furniture, and for a couple of reasons. One, you don't want the extra, debt. But two, moving into a new house, some people are like, this is a new chapter in our life. This is a new beginning. They want to obtain all, new things.
Yeah.
But sometimes, helping my clients personally, sometimes you just want to wait. I always tell my clients, don't be in a rush. You need to just go in the house, sit in the house, get a vibe of it, and then make sure that you get the furniture that will match like the vibe that you're trying to create in each different room. Don't rush to get furniture.
Yeah.
Even if it's on sale, you just want to make sure that you have the right pieces in your home, because this is where you'll be spending a lot of your time.
Yes. Okay. So no furniture. Furniture is still expensive. That is still debt, right? That's still taking out, you're having to finance the furniture.
Yeah.
What are some other things? So don't take out debts, don't finance furniture, don't, no big ticket items where you're going to have big payments.
Yeah.
What else should you not do?
I definitely wouldn't max out any type of like credit cards or loans that you have.
Okay.
That affects your credit card utilization. And Cacy, where would lenders like to see your credit card utilization stay?
Yeah. So your goal should be to keep your balance as low as possible, which is your credit utilization. Your credit utilization is how much you utilize your credit card, so what your balance is.
Mm-hmm.
How high do you run up your balance on your cards? You want to keep it as low as possible. Statistics say to get the absolute best credit score, you want to keep your balance at 2%. Now that can be really hard. 2% is, basically next to nothing. But the rule is to keep it under 20%. If your credit line is over 20%, if your balance is over 20% of your limit, then there's a good chance that credit card's hurting you and not helping you.
Okay, so what you're saying is 20%. So if my credit card limit is $2,000, what is the amount? What is 20% that I can't go over? That would be $400, right? Okay, so you got a $2,000 credit card. I want to help y'all. $2,000 credit card limit. Yes, you can spend all that. But like Cacy said, getting closer to that limit and over that 20% can hurt your score, right?
Yes.
So know and write this down, or maybe put a sticky on the credit card, knowing that you can't go over, or you should not go over $400.
Yes, yeah. Keep it, and that should be that's like the limit. It should be goal never. You don't ever want to hit for it. You know what I mean? You should be really trying to keep it under that.
Absolutely. And like I tell my clients, things happen. Life happens. Emergencies happen. Let's say you have that same $2,000 credit line. Because Tasha and Cacy told you not to go over $400, but man, the tires blew out. Oh man, I'm kind of short on cash. What do I do? What I tell my clients is you can use it. You got to get to work. You got to have transportation. Go ahead and use the credit card if you need it, but make sure you understand the date that your credit card reports to the credit bureau and get it back under that $400 before that time hits, so it doesn't show that you ever even used that amount.
Yes, and another thing is if you know your utilization is going to be high, ask for an increase. If you're in one of those oh no moments and you have to use your credit card and you haven't had an increase on the line in a while, call and ask them to increase your limit, so that way when you do put a balance on there, it's that 20% is a little higher. You can use a little more on that card.
All right, great. One of the other tips that I want to suggest when you're trying to apply for a mortgage is don't co-sign for anybody, any type of line of credit or debt. Don't co-sign for a car. Don't co-sign for a furniture bill. I understand that it's important. We want to help our family and friends out. But when you're trying to obtain a mortgage, it's a very difficult process, and you don't want to run the risk. And so, Cacy, when you co-sign for someone a debt, how does that impact their credit?
So, when you co-sign, that is your debt too. That is, you are equivalent in the loan, whether it's a car or furniture, whatever it is. Co-signer means you are the other person on the loan. So yes, this person's going to make the payments, but they don't care. If that loan doesn't get paid, that is your credit score that is still going to be affected. The moment you co-sign for something, that account is on your credit report. It doesn't just transfer to you if the other person decides they stop paying.
Okay.
It's there from the beginning, and any late payments they make on that account are going to show up on your report. If they stop paying, it's showing up.
Okay. Now, does it matter whether you're the first signer or the second signer? I get that question sometimes.
No, if you're on the loan, it's on your credit report.
Okay.
Absolutely.
So you're even Steven.
Yep.
All right. All right. So another thing that some things that you may want to avoid is having hard inquiries on your credit. And this is a
Yes.
question that I get a lot. And Casey, maybe you can help explain that. What is the difference between a hard inquiry and the impact on your credit versus a soft inquiry and the impact on your credit?
Yes, so that's a really good question. Now, a soft inquiry is going to be where, let's say, like you have a cell phone, you have your cell phones, and new iPhone comes out or the new phone comes out, and you want it. You already are established with Sprint. And Sprint is going to, instead of running a hard inquiry and going back and checking with credit bureaus, they're going to do a check within their company because they already did your hard inquiry when you signed up for your first line. So they're going to run an inquiry and a soft inquiry and say, okay, have you made any late payments on your cell phone? No. Do you have internet or TV with us? Have you made any late payments with our company at all? No. Okay, you're approved. And that's the credit check they're doing, a soft inquiry within their company, really. A hard inquiry is what you're going to get when it's something new, a company you have not dealt with before, a bank you haven't dealt with before, new financing, a new store that you're financing with. That is going to be a hard inquiry. They do not have any of your personal information on file. They have not verified you are who you say you are. They have to run a hard inquiry to give you that line of credit.
Okay, that makes sense. So anywhere that you're not established, anything that you're trying to obtain for the first time, brand new account, hard inquiry, it's going to definitely impact your score.
Yes.
Somewhere where you're already established, let's say a credit card company, a cell phone company, cable, internet, TV, you're already established. Maybe you're trying to obtain some different service. You're already established. That's going to be a soft inquiry, not going to impact your credit.
Yes.
Okay.
Yeah, absolutely.
Okay.
So that's the difference between soft and hard.
What about when now where you've made all these steps, you're like, Tasha and Casey, now I am ready to apply. What are some suggestions or some tips that you have when you're actually on the computer, on the app, you're filling out the loan application?
So I would say before you ever fill out a loan application, and if you're on that computer, you're getting ready to fill, you better stop. You need to move over and you need to pull your credit report first. You need to know what's on your credit report before you ever fill out a loan application. When you think of your credit report, like people don't realize, like you have to think of 7 years of your like financial footprint of every time you've applied for something, every time you finance something, every time you had a credit line, a loan, that's on your credit report every single time. You know, every time you've got a medical bill, it's on there. So you know what's on your credit report first. Lenders are going to pull it no matter what. That's always going to happen no matter who you go to. They have to look at your credit report. You should know what's on there as well. So that way there are no surprises. Like the first thing they're going to do, lenders, is that they have to pull it just to see, you know, you are who you say you are. They want to make sure that all of the information, the personal information you're putting on your mortgage application is correct. So, you know, you want to make sure that you fill out everything right, because let's say you are a junior or a senior, you have a surname and you don't put that on your mortgage loan, but then that shows up on your credit report, you're going to get flagged for like, you know, possible identity theft or something like that. And it's going to put a big hold on your mortgage loan because all of a sudden, you know, you have a mismatch of names. And for a loan that big, they have to be careful and make sure that you are the person who you say you are.
You know, you bring up a good point, and it comes to, you know, just that communication, like with your lender, your realtor, or even your credit repair specialist, is be honest. When you fill out that application, or when you're talking to a lender or a realtor, credit specialist, whatever it is, just be honest. The more open and honest you are and you bring that information to the forefront, the better situation that we can set you up and make sure that you're on the right time frame to get your home, because it's going to come out anyway.
Yes, it's going to come out. Like I said, they're going to pull it no matter what. So you don't lie to your doctor, you don't lie to your lawyer, and you don't lie to your loan officer or your realtor, because it's like they're going to find out. You want to make sure that, your loan officer is there to help you, and that is a huge thing. Any like loan officer and your realtor and your loan officer should be like your partners and getting your mortgage loan. Like those are your people who are going to tell you, no, you don't qualify yet, but you need to go seek credit repair, or, you know, you need to just pay these few things down. Like they're going to be able to help you go the right direction, even if you're not there just yet.
Yeah, you bring a really good point and something that I want to address. It's really important that you establish a relationship with a realtor, someone that you're comfortable with, being open and talking to about your situation. Because as realtors, especially for me, I work with a group of lenders that help people with their unique special situation. Everybody that applies for a home loan, your situation is not going to be the same as your brother, your cousin, your sister, your mom. Everybody has their unique situation,
Yeah.
and it's not going to be the same. And you definitely want to have the right lender to help you in the right situation. And also, another thing why it's important to partner with the realtor is because sometimes if you don't have a good lender or you run into a lender that's not very helpful, you can have a lender that will tell you no.
Yeah.
And it's easy to get discouraged and you want to give up. I have the exact situation with the client that I'm working with right now. A lender told her no.
Yeah.
She reached out to me. I knew some lenders that could help her in her situation, and she was approved, and she actually closes on her home next month.
So that means like the whole, like, you don't talk to a realtor until you're pre-approved. That's not always the case, because
No.
sometimes in this case, like you just said, she reached out to you even though she wasn't pre-approved, and you have connections with other lenders, and that makes sense. The average person doesn't have a bunch of connections with mortgage lenders. You're a realtor, and this is what you do, so
Absolutely.
you have those connections. So if you've been told no, or if you are even worried about being told no because you are on like a lower income spectrum or a lower credit spectrum where you're not trying to get approved for the highest thing, maybe reaching out to a realtor is a really good idea because you have resources like that.
Absolutely. Like you, for example, Casey's a great resource for credit repair and financial planning. And what I do with my clients in particularly, I in-depth screen them so I can absolutely have an overall clear picture about where they stand. And sometimes I can save them from even getting that hard inquiry with the lender at first. If I see some red flags or some things that can get them, a better deal, I'll go ahead and say, you know what, let's do X, Y, and Z, and then in 2 months, then you can apply, or we can do this, or we can seek credit repair, or whatever the circumstance is.
That's awesome. So talk to your realtor and talk to
Absolutely.
your loan officer because they're going to help you out.
Absolutely.
So you guys are there to help, and lenders are going to be able to see everything on your credit report, just absolutely everything. And that's what you really want to be able to communicate to your lender and your realtor is like, hey, this is my situation. These are the things I'm worried about. And if you know what's on your credit report and you can communicate that, that's really great.
Yeah, and that's one of the things that you're able to do too. You actually, with the client's permission, you're able to actually have conversations with their lender that they're partnering with. Tell us a little about that.
So if, like with the clients I have, we help people get homes. So whether they already have a lender or they need one and we need to connect them, we talk to lenders about our clients' situations before we have them go and get the green light to run the inquiry. That is something we do. So they do one, I'll reach out to my lenders that I work with, and I'll reach out to them if they don't have one, but we have them take a look. So that way, I do credit repair. I'm a repair specialist, and I generally know what somebody needs for a mortgage loan. But just like you said, different lenders or different brokers, mortgage officers, there are different lenders. So where incidences where you might be told no, you may not. So it's good to you can have different people look at your report and give you some advice. Absolutely. So they're going to see, you can give your report, but also you want to know that everything is going to match up, because you're going to have to fill out your mortgage application, and like you said, you're going to be honest, and you want to make sure everything is exact. So it's also important to know that's why you need to know what's on your credit report. Even something as simple as personal information, not even getting into like your financial stuff yet, but even just at the very top of your credit report where it says your name, your address, your employer, your date of birth, and that all has to be correct. If you fill out your mortgage application and you forget your surname, like your junior or your senior, that can put a whole halt on your mortgage loan, because all of a sudden there's an identity issue with them pulling, and having that name mixed up.
Yeah, absolutely.
So you have to think of that. All of your personal information has to be absolutely correct. And then they're also going to be able to see everything. They're going to look at your entire credit report. So in your head, you're thinking of everything you've done in the past 7 years financially. Like every time you've applied for something, every time you've made a payment late, every time you've made it on time, that's all listed on your credit report. So it's hard to remember 7 years worth of payments and accounts. So as you get older, you get, big girl bills, and they accumulate. So your credit report's how you keep track of your financial history. So everything from like even late payments. So like a lot of times, you may have, like, go back to cell phones, an old cell phone account, a few years ago that you made a late payment on. And even though you've already switched over companies and paid that off, you don't have phones with them anymore, that time you made a late payment is still sitting there. Your balance is zero, but that little late payment back from 4 years ago is still there and documented, and your loan officer is still going to say, well, what happened here? In the underwriting, they're going to want to know every little thing.
Yeah.
So, it's important to also go back and like find those late payments and remember, why was I late here?
Yeah.
And then just, you also know, like, now anytime you do pay something off, it is so important to pay for deletion. If you do not pay for deletion, your balance goes to zero, but the account is still sitting there. So it's okay if the account's positive and you don't pay for deletion, but if you have an account that you made a late payment on and you pay it off, but you don't pay for it to be deleted, that late payment will always sit there. So if you pay off a medical bill, you pay off a phone bill, whatever it is, and make sure you say, I want to pay for deletion.
Okay.
That's what you want to make sure.
So, it's a kind of way to think about your credit. It's like a report card, when you're applying for college, you have to submit all your transcripts and look at all your grades.
Oh, yeah.
If you don't make that certain, if you didn't have that certain GPA, you can't get into that certain school. So you can kind of apply the same concept when it comes to applying for a mortgage, right?
Yes. Like, you want to get great grades if you want to live in that in that neighborhood, in that dream neighborhood, the dream house.
So you brought up a good point talking about accounts that may have reported negatively in the past. And even though it's paid off, it can still impact you. What about inquiries? Like, for example, car dealerships. The biggest tip that we can say is when you're trying to apply for a car, go to the bank first. Don't go to the dealership first.
Dealerships like to do what I've heard referred to as the shotgun method. So they just sit there and like boom, 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 run your credit report with all of these different banks to get you approved. And they just do them all at once. And I'm not talking about like 2 or 3 banks. I mean like 15 to 20 banks, sometimes more than that, just to get you approved. They'll just run it with every bank they have. So that way, if you say, no, you don't want this deal, they have another one with a different interest rate, and whatnot. So when you go to the dealership, yes, you can tell them, only run your credit, if you're on that lower credit spectrum or that lower income spectrum, you can say, maybe can you start with a bank that you would most likely approve me? Please only run my credit with 2 and let's start with that. You can say those things, but like your point was you can also start with your bank. If you have a bank you're already established with, especially like a credit union where they have amazing interest rates for your auto loans, go car shopping, and then instead of using their financing, find your car and then call your bank and say, okay, this is the car, this is the VIN, what can you do for me first? And like we talked about soft and hard credit inquiries, that bank already has a lot of your information.
Yeah, so I couldn't imagine 10 to 15 hard inquiries on your credit. Ouch. How, in the past when you reviewed people's credit score and you've seen those inquiries for auto loans, how much of an impact have you seen that make on a score?
Oh my gosh, it's so sad. I've seen it drop people 100 points.
Wow.
That's a lot. It is hard to recover from 100 points.
Whew. Okay, so go to the bank if you want to get your car. Don't go to the dealership first.
Yes,
all
absolutely.
Right. Okay.
So they're going to see inquiries. Another thing is, yes, cars are going to see when you, cars run your credit a lot. It's also with student loans. Student loans are going to sit there as well. So those are like the 2 big things when it comes to mortgage loans, is like cars and student loans. What do you have going on there? So student loans, a lot of people think like if you have student loans, you can't buy a home until they're paid off. Like, oh, I got student loans, like I'm out. Not the case. absolutely not the case.
Okay.
And you have different stages of your student loans. So if you're still at the point where you're not, you don't have to pay on your student loans yet, they're still deferred.
Mhm.
But you have the debt taken out and the debt is there. What they're going to do is they're going to take 1% of your entire balance, and that is going to be considered your student loan payment for right now. Because you're not making those payments yet. Now, if you are already making payments, they're going to either use the payment you already have for your debt to income ratio and calculate that. Or if your student loans are in default, something you can do is actually go on a rehab program. And then a rehabilitation program for student loans lets your student loan payments be income based. And a lot of times they'll give you paperwork even stating, your payment agreement. And it says in there that it's a income based. You provide your tax returns and it's an income based payment. So you can show that paperwork to your loan officer. And that's proof that your student loans are tailored around your income. And that's how they decide your payments.
Okay. Awesome.
Yeah, so that is going to help with your debt to income ratio. Another thing that they are going to see on your credit report is going to be credit utilization. Like we mentioned earlier, there's that difference between credit lines and loans and debt, but if you they're going to see when you run up your credit cards. And if you've ever ran up your credit cards, a lot of people don't know that the credit cards they have are all listed on their credit report. And then there's a part on your credit report called your high credit. And that's the highest you've ever spent on your credit card is documented. So if you've maxed out your credit cards, if you've hit over the 20%, it is documented. So it is really good. Like when you get a credit card, to put a sticker on there or something for the 20% limit, and don't ever let it hit that 20%, or don't ever max out your credit cards, because once it's on there, it's documented and it's staying there.
Okay. Or what happens in the situation, funds are tight, emergencies happen, we understand life happens, but the tires blow out. What I like to tell my clients is if you got that $2,000 credit limit and you're doing good because you listen to Tasha and Cacy, and you're not going to go over the 20% utilization, which is $400. Let's say you got to buy the tires, on the credit card, but understanding when your credit card reports to the credit bureau and making sure you pay that back down before that hits.
Right. So yes, there's a day of the month that they update everything that you can, that you can kind of make sure you make your payments in time. Another thing is, like, say you're not going to be able to make that payment in time. Like you're taking out those tires and your payment is due next week. You can actually call and ask for an increase in your limit. And then you're not maxing out that card, or going over your 20%. You can actually ask for increases in your card limits every 3 months. And as long as you haven't made any late payments and you have good standing with your credit card, they're most likely going to give you the increase. They want you to have it. So that's something you should be routinely doing, is just calling and asking for an increase every 3 months.
Okay, awesome.
Yeah. And then another thing is that people don't realize is that lenders are going to look over their credit report, but they also need to look over their credit report, because 7 out of 10 people, Tasha, have stuff on their credit report that is not theirs, that they didn't even know was there.
Say that again.
7 out of 10 people have things on their credit report that are not their accounts.
How does that happen?
It happens. I mean, think about it. There's 250 million people in the credit system, and the chances of somebody having the same name, a similar social as you, and something getting mixed up, it happens all the time.
Wow.
This is why I stress credit monitoring all the time. And generally, people who are trying to apply for stuff are looking over their credit, but this is why it's so important to look at the report and not just the scores, because you can be looking at your scores and think I'm good, but then you pull your report and there may be something on there that isn't yours or that you didn't know. So it's really important that you handle those accounts and that those aren't yours, because something can come up that's not yours and then stop you from being able to get your home.
Wow.
So, and it can take a little, a month or a little bit to take care of it, and you wouldn't want it to delay you from getting the home.
Wow, had no idea. That's really, really important.
Yes, absolutely. So that's all the stuff that lenders are going to be able to see on your credit report. That's all the stuff you can see as well, and you should be watching before, and you should know before you go to the lender's office. And then we also talked about all the stuff you should not do when you're going to apply for a mortgage loan and things you should do. We hope you guys found a ton of valuable information in this video. If you guys liked it, please like and subscribe. We'll be here with you guys next Thursday. Until we see you next time, again, my name's Cacy Matano with Austin Credit Care.
I'm Tasha Green with Go Green Realty Group.
And we'll see you guys soon.
Bye.